Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we explore what is possible in the world of investing. If you've just joined us for the first time, a massive welcome to the community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode, and I want to say off the top, there's been a few comments recently. If I know, I say I'm excited every episode.
If you know.
If I know.
Oh, as in like people are like, do you realise?
Yeah, does Ren realise you say he's excited every episode?
Come on.
And I want to say right off the top, yes, I do know, and it is because I am excited. And how could I not be excited when we get to speak about investing and money and finance? Not only are we breaking the taboo, we're breaking the perception that it's boring.
That's it. Well, we have a massive show today. We're going to answer a community question around the Vanguard Asia ETF that Ren and I both own. We're going to talk about why we love stocks and the difference between investing and speculating. But to kick off, as always, we've got news and views.
News and markets.
Now, Bryce, the news of last week really is the US election. A lot happened. We released an interview with Twiggy Forrest. Melbourne Cup ran. The US Federal Reserve met. The Reserve Bank of Australia met.
What a week.
It was a big week.
Huge.
Bridget McKenzie figured it would be a good week to bury a few confessions.
Yes.
And she was right. She played the media well there. But look, yeah, the big news is obviously Trump winning and the Republicans really sweeping back into power through all the houses in the US. We're not going to talk about the politics of it all, but I think it is worth just highlighting the market reaction, because the market's immediate reaction, I think, really tips the hand of where investors and large financial institutions think Trump's policy may take the US economy. And obviously where the US economy leads, a lot of the world follows. So what were some of the big notable market moves across different asset classes that we saw?
Let's start with the big one. The S&P 500 had one of its best days for the past year, up 3%. Absolutely
big
rocketed.
one-day move.
Rocketed.
Yeah. Do we want to go through the market moves and explain them, or do we want to explain them as we go?
Let's explain as we go.
Okay, so what was the big driver of the S&P 500, the stock market index jumping?
It's driven by Trump's policies that off-air what you described as unshackled balls to the wall. So look, he's got a lot of corporate tax cuts planned.
Yes.
Corporate and income. I mean, energy policy, a lot of economic growth policies.
He's going to try and drill as much oil and gas out of the US land mass and surrounding oceans as he possibly can in 4 years, which is ironic because the US is already at record production of oil and gas. He's going to cut regulations and people think that's going to drive economic growth. So that's really the long and the short of it there. Another market that had a great day, Bitcoin, jumped 7% in the day that Trump was elected.
Massive, yeah. So this comes off the back of Trump saying that he is going to make the US the crypto capital of the planet.
Yes.
Very bullish. Probably the most obvious trade leading into it if it was becoming clear Trump was going to win. The amount that the crypto guys spent on him is ridiculous. Hundreds of millions. But anyway, yes, Bitcoin up 7%.
Hit all-time highs, crossed
all-time highs.
$75,000 US dollars a coin. And I think the previous all-time high was like 73 something. So it dipped back a bit. Yeah, Bitcoin had a good day. Speaking of jumping higher, the US dollar also jumped higher. Ironically, not what Trump wants.
No, not what he wants. But it rose against major trading partners. So the Japanese yen, the euro, the Mexican peso, and the Chinese renminbi all fell because of the proposed tariffs that Trump is going to put against these trading partners.
Yeah, so in theory, that will hurt all those countries' exporters, and then people will be buying less of their currency to buy goods from those exporters as a result. And so they all fell. The euro recorded its worst daily fall against the US dollar in more than 4 years. Now, we had that throwaway comment, not what Trump wants. Just to explain that, it's because Trump, but in particular J.D. Vance, he's been really out in front of this for about 60 years, really. Oh, no, more than that. Since World War II, the US dollar has been seen as like the global reserve currency. The strength of the US dollar has been really important for global economics. It's been really bad for US manufacturing and US exporters because their products are more expensive to sell around the world. And J.D. Vance especially has been speaking about how they can weaken the US dollar to help US manufacturing and exporters. So that is going to be something to watch and attention to watch, as tariffs on one hand may drive up the US dollar, but other policy goals will be to weaken the US dollar.
Oh, yeah. So that leads us to fixed income. There was a big sell-off in fixed income with bond yields rising, potentially a warning of things to come. Ironically, again, it feels like a lot of the election was driven by people's attitude towards inflation over the last couple of years. A lot of analysts think, though, that a lot of Trump's policies are going to be very inflationary.
Yes. Two in particular, the tariff policies are if you're importing something from around the world and now all of a sudden that thing has a 15% tariff on it, that cost does get passed on to the consumer. Over time, it might increase US domestic production of said product, but in the short term, it will be inflationary. The other policy that people will think will be quite inflationary is Trump's proposed mass deportations.
Yes.
That, in theory, will constrain the labour market and push up labour costs because businesses' demand for labour will still be there, but the supply of labour will be lessened. And so in theory, that will be inflationary because those higher labour costs get passed on to the consumer as well. So that is why fixed income sold off. And when the face value of fixed income sells off, bond yields rise, and it's because they expect inflation to follow and maybe interest rates to get raised on the back of higher inflation. So Bryce, to recap, the S&P 500 was up 3% in a day. Bitcoin jumped, the US dollar jumped, fixed income and bonds sold off. The last one that we think is worth making a note of is Tesla. Elon Musk's electric vehicle company jumped 15% in a day.
Yes. Well, you can only put it down to him being now in the pocket of the President of the United States.
No, who's in the pocket of who?
Well, Trump is in the pocket of... Trump is in the pocket of Elon Musk. I mean, he got a shout out in his, not only a shout out, but probably like a 10-minute dedicated part to Trump's acceptance speech. Unbelievable. Look, obviously we're not sure what's going to happen, but people are assuming that because Musk is now close to Trump, there might be some flow-on effects to subsidies and the like, but who knows?
Which is ironic because I reckon if you polled the newly elected Republicans and Trump and J.D. Vance, they would certainly not be in favour of electric vehicle subsidies. In fact, I do remember J.D. Vance when he was just a senator before he was a VP candidate arguing that not only should America get rid of electric vehicle subsidies, but he actually wanted to see subsidies on internal combustion engines. So that feels like there might be a bit of a internal inconsistency there with what the market thinks will happen with Tesla and what newly elected Republicans think about electric vehicles. But look, I think that's the long and the short of it with the Trump stuff, that the market moves were really notable and worth talking about. But we've got months before he becomes president and we've got years while he will be president. And I think what happens is going to happen slowly and over time. And so it'll be a watch this space and let's see what happens. But let's come back to Australia for one quick other news story that caught our eye. One of the giants of Australian business leadership, a very long tenured CEO, 22 years at the top, is stepping down. Don May, the CEO of Domino's.
Yes, May took a local franchisee pizza shop and made it into the international giant that it is today and was once a darling. Well, I mean, Yeah, once a darling on the ASX. He spent 40 years with Domino's, including 22 years as CEO. And we were lucky enough to actually speak with him a couple of years ago. So make sure you go and check that out. But mixed reactions, I think, Ren. His supporters would say that he's done an incredible job taking it from 135 million valuation to, 3 billion?
Yep.
The other side of it is that Domino's was worth 14 billion in September 2021, but it has now lost 80% of its value in the last 3 years.
I know, it's pretty brutal, isn't it? Yeah.
They called themselves a tech company at one point.
They did. I think that was pre-COVID. Well, yeah, they had the delivery robot and like they took the master franchise for Australia, made it massive, but then they now have stores in Japan, across Europe. Interestingly, they even tried to open Domino's in Italy.
Yes.
That was never going to look too good.
Good luck. All right, well, we love hearing questions from the community. Please, if you want to ask one, there is a link in the show notes or in the comments below to leave a voice note. But this one has come through from a community member on our Facebook page. He asks, hey mates, I was listening to today's podcast when Bryce mentioned that neither of them invest in emerging market ETFs, but from memory, I think Ren invests in VAE, which is Asia x Japan, and pretty much has the same country exposure to the emerging markets ETF that I invest in, EMKT. So I'm a bit confused. Is there a tangible difference? Thanks. Good question.
It is a good question. And I think on the face of it, it is correct. So we had a look at the two ETFs under the hood. EMKT, the Emerging Markets ETF, the 5 biggest country weightings: Taiwan, 24%, China, 23%, India, 23%, South Korea, 15%, Saudi Arabia, 2%. So that's the Emerging Markets ETF. VAE, Vanguard Asia x Japan, China, 32%, India, 23%, Taiwan 19%, South Korea 11%, Hong Kong 5%. If you get lost in the percentages there, don't worry. The point is that the 4 largest country weightings that together, it's probably 80% or just shy of 80% of each of those ETFs is 4 countries, and they're the same 4 countries: China, India, Taiwan, South Korea. You look at the ETFs, the management fee on VAE is smaller, 40 basis points rather than 69 basis points. But really, right now, if you look at their ETFs, they're very similar.
Yeah.
So it's a fair call out and it's a fair question. Now, the question was directed at me, but it's actually a question for both of us because you also invest in VAE. So do you want to answer it first, then I can share my answer? Why are we saying on a previous episode of the podcast, emerging market ETFs are not for us, but then we invest in this Vanguard ETF that looks quite similar under the hood?
I think for me, it's like the emerging markets ETF will always be an emerging markets ETF, and it's likely that, I would hope that those top positions move out at some point or become don't be classified as an emerging market, if that makes sense.
Become developed markets.
Yeah, China and India, but they will always be in the Asian index. And so for me, that's the exposure I want. I don't want to have the up and coming, African countries or whatever it is that comes up into those emerging markets.
Yeah.
Does that make sense?
Yeah.
So for me, it's at this point in time, there is obviously correlation. Arguably, some of those countries I wouldn't even say are emerging. But I imagine in the future, that's not going to be the case.
Yeah.
That's really it.
Yeah. Very similar to me. So, first of all, question around categorization. It's an interesting argument to say that Taiwan and South Korea are emerging markets. I think they're major developed economies with high standards of living, high disposable income, but that is a separate conversation.
Yes.
And, as you said, in decades to come, maybe it won't play out, but maybe China falls out of the emerging markets definition and becomes a developed market. The purpose of the investment is to get global geographic exposure. And however things change over time, I still want Asian exposure, but I don't want emerging markets exposure for the same reasons that you said. It's because who comes up through the index over time is probably less interesting to me, and the weightings of those are less important. But I think this is something that you'll see often in investing when you see there are so many ETFs that will cut markets in different ways, cut them by geography, cut them by factors, like quality, growth, value, cut them by size, mid cap, small cap, large cap, that you will often see different ETFs that at a single point in time might look quite similar. But the question isn't how they look today. The question is how they will change over time and what your investment thesis is around that. And look, as we've said, we're investing for geographic diversification. Right now, the biggest emerging markets are in that particular geography.
Yeah.
But, that hasn't always been the case, and it won't always be the case.
Yeah. Well, thanks for the question, and thanks for keeping us on our toes as well. We really appreciate it. Join the Facebook group if you want to ask a question there, or leave us a voice note, and we'd love to get you on the show. We're going to take a quick break, but just a reminder about our sister podcast, Get Started Investing, where we cover everything that you need to know to get started on your investing journey and all the fundamentals, as well as deep dives on a lot of ETFs that are important to our community. And in tomorrow's episode, we're looking at the best ETFs for quitting your job. Yes, that's right. Quit the 9 to 5. We'll show you how.
Yes.
We're going to take a quick break, and on the other side, we're going to look at why we love stocks and whether you're investing or speculating. We'll be right back. Welcome back to Equity Mates. Now, Ren, I have a question for you. Are you investing or are you speculating?
Always investing, Bryce. Always investing. Now, for people who aren't familiar with where this question comes from, it comes from Seth Klarman, one of the best investors of his generation, who wrote the book Margin of Safety. Now, he asked, are you investing or are you speculating? Because people will conflate the two things, but for him, they're different. Speculating is when you buy something with the expectation that someone will pay more for it in the future. You buy a Picasso. You'd better hope there's someone who loves Picasso or who's an art collector, because the only way you make money on that is if you sell it for more than you bought it for. A bar of gold, same thing. That's not spitting out income for you. You've got to find someone who's going to pay more than you paid for it. Bitcoin, same thing. You are predicting that the price will go up and someone will buy it off you for more. Even property, and this is controversial because there are ways that you can make income from property.
But I mean principal place of residence. You're literally buying it.
Even in investment property, you can subdivide it, you can rent it out, you can do all these things. But at the end of the day, the block of land you buy is the block of land you sell. Yeah. It doesn't fundamentally change all of those asset classes. They can all be great investment asset classes, but they rely on an element of speculation because they rely on someone being willing to pay more than what you paid.
That's it.
It's different when it comes to investing in companies and the stock market.
Yes, which is why we think the stock market is the best option for investing. So if you're buying a share in a company, it is constantly changing. It's evolving, it's growing. What you buy can be completely different from what you actually sell. It's the company is managing a group of people who are out there actively working for you as the shareholder, building products, expanding into new countries, trying to be more productive. And the way that you make money in the stock market isn't just by finding someone willing to pay more for the same thing. It's letting the companies themselves actually become more valuable.
Yeah, to wait as the people running these companies find ways to make more profits, to create new products, to expand into new markets, and in some cases to come up with entirely new businesses.
Well, give us an example.
When you eventually sell, it's completely different to what you bought.
Yes.
You want an example?
Yeah.
I'll give you an example. Let's look at Amazon, the online retail giant. Amazon listed in 1997.
Yep.
If you had bought a share of Amazon in 1997...
Bezos had hair?
Oh, don't know about that.
Okay.
Bezos certainly had less HGH, allegedly. Well, no, not HGH, testosterone.
Yes.
So Amazon at the time was worth $438 million. It was an online bookseller with 256 employees and $15 million in sales.
Yeah.
A fine business. 24 years later, if you just held on until 2021, Amazon was a retail giant and a web services provider with over 1 million employees, $280 billion in sales, and worth $1.6 trillion. What you bought was shares in an online bookseller. What you sold was a much bigger, much better, and much more valuable company. And here's the thing as well. It's not even like you had the same number of shares in the company because of all the share splits. And it's not like you even had the same percentage ownership of the company because of all the buybacks.
Yeah.
So like what you sold, how much you had, what percentage you own, it all fundamentally changed over time. And that is why we love investing. Now, Amazon is probably an extreme example. It's definitely an extreme example. It's one of the best investments of that time. But
any tech company.
Yeah, but I think that we can take the most exciting retail investment, but we can also take the most boring retail investment.
Whoa, come on.
Let's look at Woolworths.
No.
Because the same story plays out there.
It does play out. Very exciting company, may I add. 20 years ago, it was Australia's largest supermarket. Even starting out as such a big company, it's grown and changed over those past 20 years. It's tripled the number of stores, expanded into new countries. It's gone online. It's got multiple divisions now beyond just grocery retailing. The business is constantly trying to find ways to make you money as a shareholder.
Yeah, so to put numbers to that, so in 1997, as you said, it was Australia's largest supermarket, but it had 125,000 employees, 1,114 stores, and $20 billion in revenue. Fast forward to 2021, it still was Australia's largest supermarket, but it had 215,000 employees, 3,357 stores, and $64 billion in sales. It had almost doubled its employees, it had tripled its store count, and it had more than tripled its revenue. The thing that you buy and the thing that you sell, even though both of them just said Woolworths on the tin, they are fundamentally different. And so to tie it back to the question, are you investing or are you speculating? It's not like you're buying a painting or a bar of gold and asking and assuming that at some point in the future, someone will pay more for that same bar of gold or that same painting.
Picasso, yeah.
The intrinsic value of the thing, the economic value of the thing, the amount of profit it creates, the amount of income it pays you in dividends, like that fundamentally changes over time. And sometimes it changes for the worse.
Yeah, I was going to say, can't go the other way.
If you pick the wrong stock. But what we've learned time and time again,
it's not based on
generation after generation, is that there are some massive winners at every generation. And your job as an investor is to find those winners and hold on to them, or to buy an index that through the structure of the product will have those winners in it.
Yes.
But that's why we love investing.
We love investing, and that's a high note to finish on. If there's anyone that you think needs to be convinced as to why they should start investing, maybe send them that segment, because that's left me feeling pretty pumped as always. But thank you for listening. We'd love to hear from you. If it's a community question, if it's submitting to Pimp My Portfolio, please head to equitymates.com/contact. All the information is there. And if you're really enjoying the show and you're getting a lot of value out of it, if you can just leave a rating and a review, it'll take you less than 2 minutes on your podcast app. It does go a long way for us as well. But Ren, that's it. Great to chat as always. We'll pick it up next week.
Sounds good.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.